The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Uncertain Debt Management, Treasury Markets, and Financial Institutions. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Thank you to our witnesses for joining us today in the Financial Institutions and Monetary Policy Subcommittee to discuss Treasury markets and debt management. Markets for Treasury securities are integral to the functioning of financial institutions and the products they provide. Trillions of dollars in Treasuries trades occur each day in the private sector and with the Federal Reserve through purchases, sales, repurchase agreements, securities lending, and more. Those trades help support provision of financial services, and they depend on a highly liquid, deep, and stable market for various types of Treasury trades. Stability of markets for transactions involving Treasury securities has been at risk at various times, and Treasury security holdings of financial institutions recently came to the forefront in the form of bank runs and failures. The rapid escalation of interest rates engineered by the Federal Reserve following a prolonged period of near-zero short-term interest rates placed many Treasury security holdings underwater and marketable to a loss at current market prices. That was at the heart of the failure of Silicon Valley Bank and subsequent banking system instability. Instability in markets for Treasury securities also began to arise given uncertainties surrounding the recent debt limit negotiations and our approach to a breach of the statutory debt limit. Today's hearing is what I intend will be the first of several exploring markets for Treasuries, given the importance of those markets to financial institutions and the provision of financial services. During the debt limit debate, as was the case in prior debates when we got close to default, information from the Treasury Department, which is charged with debt management responsibilities, was crucial. Yet in trying to discern what was going on with respect to so-called extraordinary measures, which have become ordinary, and about the so-called X date, Treasury was not as transparent as it could have been. In deciding something as important as a limit on federal debt that now stands close to $31.5 trillion, full information is necessary. Unfortunately, information is warehoused at the Treasury and sometimes kept behind closed doors, with the Treasury Secretary able to decide what information to provide and when to provide it whenever the Secretary wants to reveal that information. That invites politics to enter into what the Treasury Department will tell Congress and the American people about the debt, how much cash is in the till, and how long the nation can stave off default. Only the Treasury Department knows best how long extraordinary measures are projected to last before we default. Only the Treasury knows best what the so-called projected X date is and which is the date of default. Only the Treasury knows best how much cash it projects will be in the pockets of the American people's till as we approach running out of cash to honor Treasury obligations. Only the Treasury, the Federal Reserve Bank of New York, and the administration know what contingency plans are in place to deal with an inability to make timely payments on Treasury securities and other federal obligations. To be clear, such contingency plans are necessary because an inability of the federal government to make timely payment can arise from a debt limit impasse, but also from adversities such as a cyber attack, systems failures, natural disasters, or terrorist attacks. I have provided today discussion drafts of bills that address these issues aimed at additional information provision and transparency for the American people, for the Congress, about Treasury debt management and surrounding issues. Today's discussion with experts from the Government Accountability Office and Congressional Research Service who have studied the debt limit and surrounding debt management issues will help us discuss how to allow the American people and Congress to be better informed about federal debt management and information about our nation's fiscal health. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chair Barr, and thank you to all our witnesses today. You know, that's recently been in the news and noticed by a lot of people, this loud noise coming from what was widely attributed to be a sonic boom from some fighter jets scrambling. However, upon closer examination, it appears that this was actually the sound of the debt ceiling being lifted over the weekend. But there is a serious purpose here in this discussion. You know, there's what I found a very insightful book called Why Nations Fail. And what it identified in country after country throughout history is the failure of nations comes about through the development of what the authors called an extractive elite, which is a group of people who capture the wealth of a country and then use that wealth to capture the political power in the country, use that political power to retain their wealth and to pass it down through generations. And so a country that's been captured this way then sees policies being adopted that are not in the long-term best interest, or in fact, against the best interest of the country. That's really what's going on in this discussion today. You know, yesterday I had the honor of being visited by a member of the German parliament. And I asked them, you know, how do you deal with budget negotiations that don't converge? You know, do you have a mechanism like the debt ceiling? Because, you know, frankly, we're almost alone in the world in having this debt limit. And you know, he was, first off, very perplexed and worried and wondered why we did this, not only to ourselves, but to the whole world economy, putting it at risk. But the answer to the question is, well, when we negotiate budgets, we agree on when the budget should be prepared, and we stick to that schedule. I guess you can do this in Germany. That doesn't seem to work in the United States, but there are a variety of mechanisms. You know, one of my favorite ones is in Israel. If the majority has not passed a budget by a date certain, there's snap elections. And I think if we had such a rule in the United States, that would get Congress's attention, and we maybe would actually solve this problem where it should be solved at the level of budget negotiations and not by this artificial rule we've made up for ourselves about the debt limit. So I must confess that I'm a little bit perplexed by the subject of today's hearing. You know, we're talking about how the Treasury Department handles the brinksmanship surrounding the debt limit and the details of the X date and so on. You know, this is a calculation that's only necessary in the United States and only because we've made up this, you know, frankly, frivolous rule and dangerous rule for ourselves. And that one, by the way, which has proven to be completely ineffective at actually reducing the national debt. And I think we should also understand, you know, the situation that really drives this. You know, it's often referred to the fact that we have a spending problem in the United States, but in fact, you know, both parties agree we shouldn't default on the national debt, and both parties agree that an uncontrolled national debt is a danger at some point. But what we don't see is the fact that there are two ways to handle this. As a scientist, I'm always a little bit annoyed when people take the ratio of two numbers which are not in the same units, like comparing apples to horsepower or something like that. It makes no sense. And when compare debt to GDP, it actually makes no sense. Debt is in units of dollars. GDP is in units of payment stream, you know, dollars per minute or year or shift. And so that it makes no sense to compare them directly. However, if you compare debt to wealth, then you get interesting numbers. The debt of the United States, publicly held debt, is roughly $25 trillion, a significant amount. The wealth of the United States is $140 trillion, the household net worth. So we are very far from bankrupt as a country. And as a result, this whole exercise we go through is a gigantic waste of everyone's time. Thank you. Yield back.
The gentleman yields back. The chair recognizes the ranking member of the committee, the gentlewoman from California, Mrs. Waters, for 1 minute.
Thank you very much, Chair Barr. 4 months ago, I wrote to Chair McHenry requesting that he hold a hearing on the harmful and potentially catastrophic consequences of the brinksmanship that Republicans were engaging in with regard to the debt ceiling. Instead of holding that hearing in a timely manner, we're holding this hearing focused on criticizing Treasury's debt management. And instead of working to ensure this kind of brinksmanship over the debt ceiling never threatens our economy again, Republicans are using this hearing to consider bills to deregulate banks and undermine the Fed's funding without regulatory experts who can discuss them. Republican threats to drive our economy off a cliff would have done real and quantifiable harm to our economy, even though we averted a default thanks to President Biden's leadership. Let's focus on learning from this and never allowing such reckless brinkmanship ever occur again. I yield back.
Gentlelady yields back. Today, we welcome the testimony of Mr. Grant Driessen. Mr. Driessen is the specialist in public finance at the Congressional Research Service. And Mr. Jeff Arkin. Mr. Arkin is the Director of Strategic Issues Team at the Government Accountability Office. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Driessen, you are now recognized for 5 minutes for your oral remarks.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, my name is Grant Driessen, and I'm a specialist in public finance at the Congressional Research Service.
Sir, could you bring your microphone closer?
Okay.
Thank you.
Better? Okay. Thank you for inviting me today to testify on behalf of CRS. As requested, I will provide a brief summary of extraordinary measures that may be used to delay a binding debt limit, discuss factors that influence when extraordinary measures will be exhausted, referred to as the X date, and touch on possible economic effects of an anticipated or actual binding debt limit. As part of its constitutional power of the purse, Congress uses the statutory debt limit as a means of restricting federal debt. Extraordinary measures represent a series of actions used to extend the time before a federal debt limit binds, and authority for their use rests with the Treasury Secretary. Extraordinary measures have been regularly invoked in recent years and have delayed a binding debt limit by periods ranging from a few weeks to several months. Ultimately, accounts and members of the public that are affected by extraordinary measures must be compensated for the delay in payment that results from such actions when the debt limit is subsequently modified. Extraordinary measures implemented in 2023 were generally consistent with other recent experiences and included the following. 1, suspension of reinvestment in the G Fund of the Federal Employees Retirement System, which was estimated to add $294 billion in headroom, or fiscal space below the limit. 2, suspension of invested balances in the Exchange Stabilization Fund, which was estimated to add $17 billion in headroom. 3, declaration of a debt issuance suspension period, which was estimated to add about $8 billion in headroom per month and would have added, as a one-time measure, $143 billion in headroom if extraordinary measures had been active on June 30th, 2023. 4, suspension of state and local government securities, which was estimated to add no headroom but prevent further debt increases by approximately $6 billion per month. And 5, exchanging Treasury securities for obligations in the Federal Financing Bank, which was estimated to add about $2 billion in headroom. The length of time between implementation of extraordinary measures and the projected X date is a function of several factors, including the projected federal deficit, amount of cash on hand in Treasury's general account, the timing of federal receipts, and the timing of federal outlays. All else equal, higher net federal deficits will lead to faster increases in debt subject to limit. There's also substantial variation in federal budget outcomes across months, weeks, and days, which can make exact X dates difficult to project even as extraordinary measures are nearly exhausted. When extraordinary measures were implemented in January 2023, initial estimates from a variety of sources generally projected an X date between July and September of this year. Those projections also identified April, when many individual income tax returns are filed, and early June, when certain large payments take place, as periods of uncertainty in determining when the X date would ultimately fall. April tax receipts were lower than expected and led to updates in early May, projecting an X date in early June. In late May, Treasury further updated their X date projection to June 5th, 2023. The federal government has never failed to enact a debt limit modification before a debt limit binds. Economic theory and evidence from recent debt limit activity indicate that the effects of an anticipated binding debt limit or actual binding debt limit could include the direct effect of late or missed federal payments on federal borrowing costs, financial market effects, both in federal security and other lending markets, and in market transactions where federal securities play a prominent role, and indirect effects on borrowing and general economic confidence from households, businesses, and other governments. Thank you for the opportunity to testify today. I look forward to any questions that you may have.
Thank you. The gentleman yields back. Mr. Arkin, you are now recognized for 5 minutes to give your oral testimony.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for inviting me here today to testify. My remarks today will cover the nation's long-term fiscal health, the impact of debt limit impasses, and potential actions that Congress can consider to address challenges that arise with both. Last month, GAO issued our 7th annual report on the nation's fiscal health, which examines the current fiscal condition of the federal government and its future fiscal path. Our central finding is unchanged from prior years. The federal government faces an unsustainable fiscal future as debt held by the public is projected to grow faster than the economy. For most of the nation's history, publicly held debt as a share of gross domestic product, or GDP, has increased during wartime and recessions, but decreased during peacetime and economic expansion. Recently, this pattern has changed. Publicly held debt as a share of GDP grew during 3 of the last 4 economic expansions. And the level of publicly held debt is projected to reach our historical high of 106% of GDP within 10 years and reach 200% of GDP within 30 years, absent any changes to revenue and spending policy. Our growing debt is a consequence of borrowing to finance increasingly large budget deficits, which occur when spending exceeds revenue. The federal government has run a deficit each year since 2002. Over the long term, deficits are projected to grow as expected revenues fail to keep pace with expected growth in program spending, particularly for Social Security and federal health care programs like Medicare. Likewise, net interest spending, which primarily represents the federal government's cost to service its debt, is projected to increase steadily over the next 30 years, further contributing to budget deficits. Debt limit impasses pose additional risks to our fiscal outlook. A failure to raise or suspend the debt limit could force Treasury to delay payments on maturing securities and interest. This would constitute a default, which could have devastating effects on U.S. and global economies, as well as the public. Our work has shown that even without a default, a debt limit impasse can be costly. Uncertainty surrounding raising or suspending the debt limit disrupts financial markets and may cause investors to require higher interest rates to hedge against increased risks. Higher interest rates, in turn, increase Treasury's borrowing costs. In terms of actions that Congress can take to meet these challenges, one thing that GAO has suggested is for Congress to develop a plan to address the country's long-term fiscal outlook, and promote fiscal sustainability, where the debt to GDP ratio is either stable or declining over the long term. Part of such a plan could include considering alternative approaches to the debt limit. One example is that we've identified is linking action on the debt limit to the budget resolution. This alternative would maintain congressional control and oversight of federal borrowing and better align decisions about the level of debt with decisions on revenue and spending at the time those decisions are made. Another type of alternative to the debt limit would be to adopt fiscal rules, which can help manage debt by controlling factors such as revenue and spending to meet a specific deficit or debt to GDP target. Enacting the changes to fiscal policy needed to achieve a sustainable debt to GDP target may require difficult decisions. For example, just to keep our debt to GDP ratio around the level that it has been over recent years over the longer term will require substantial increases in revenue, substantial decreases in annual program spending, or some combination of the two. Chairman Barr, Ranking Member Foster, and members of the subcommittee, this concludes my prepared remarks, and I look forward to any questions you may have.
Thank you to both of you for your testimony. We'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. The Fed failed to acknowledge the impact of runaway fiscal spending and insisted that inflation was transitory for far too long. Due to this failure, the Fed had to raise rates at the fastest pace in modern history, 500 basis points in only 14 months. Had the Fed begun to tighten monetary policy earlier, they could have done so at a more gradual pace with a lower terminal rate, avoiding the precipitous pace of rate hikes we saw and the resulting increased volatility in the Treasury market and the banking system. Can either of you please discuss how the recent changes in monetary policy compounded with the Fed's decision to operate at near zero interest rates for far too long impacted the Treasury market? And how does Treasury selling at a loss for many institutions in our financial system affect the safety and soundness of the system as a whole? Either of you want to take that?
I can provide maybe a limited answer. So my research is really more focused on fiscal policy, and so certainly the fiscal policy and monetary policy are not entirely independent of one another. Certainly, as Jeff mentioned, interest rates are something that really determines our net interest costs, and that's a huge factor in the future of federal budgeting. But kind of outside of that, I don't think that there's too much to say in terms of kind of beyond that an already unstable market for any sort of reason would be more dangerous surrounding a debt limit episode.
Let me just ask either one of you, does a precipitous rise in interest rates, that fast of a rise in interest rate, make it harder for bank management to manage interest rate risk, and does it make it harder for bank examiners to supervise institutions under that kind of an interest rate environment?
I mean, it certainly can increase risks for banks, and we saw this recently with the failure of certain banks like Silicon Valley Bank. We reported recently that Silicon Valley Bank had failed because of weak liquidity and risk management, and hadn't really hedged against that interest rate risk, and that was one of the causes that caused its downward spiral.
Yeah, one of the concerns that I'm hearing from market participants is with regard to the drain of dollars from the financial system resulting from the Fed's reverse repo facility that provides money market funds a relatively good return on overnight lending. We're seeing dollars being taken out of the banking system and parked at the Fed. And I've been told this was particularly impactful when we were seeing a shortage of liquidity in the banking sector during the Silicon Valley Bank and Signature Bank runs. If the Fed continues paying high rates for parking dollars at the Fed instead of at banks where money can fund lending, will we continue to see market distortions?
Yeah, I don't have an immediate answer for that. That's something that we can get back to you on.
Much the same for me.
Well, I think we need to investigate this, and your agency should take a look at it, because this reverse repo facility is now used as a monetary policy tool, but as we see deposit migration, this could potentially be another source of instability in the banking sector. During the lead up to the so-called X date, the Treasury Department was incredibly opaque as to how it arrived at the conclusion as to when the U.S. would no longer be able to pay its obligations. The United States is on an unsustainable path in terms of federal debt, as Mr. Arkin pointed out. Congress needs to have all of the information necessary to not only raise the debt ceiling, but also introduce necessary solutions to create lasting changes to our debt trajectory. Can either of you touch on whether or not your agencies, or to your knowledge, CBO or independent analysts have expressed concern about the growth of U.S. debt and also the opacity of the Treasury Department identification of X dates going forward?
Yeah, I can touch on that. Certainly, GAO, CBO, and even the administration has touched on the long-term sustainability issue. Debt has grown substantially in terms of its relation to GDP, and projections from GAO and others show that continues on an increasing pace going forward over the 30-year period, over the longer 75-year period. And that's what we think of as fiscal policy being unsustainable, because it just keeps, that difference keeps increasing and increasing.
I'd like to talk about contingency planning. I don't have time, but should Treasury Department in general be more transparent with Congress during negotiations on avoiding default about X date and other issues?
Yeah, so I can take a little bit of that. So there are some regulations in the U.S. Code that require Treasury to report things. You can, more generally, 31 U.S.C. 3130, and then with the debt limit, there are specific portions of that. Treasury sometimes balances being a regular and predictable actor with minimizing federal borrowing costs, and so balancing those two are something you can.
I know that's unfair for me to ask a question, then gavel you down with
all right.
the answer, but I ran out of time. I now yield to the ranking member for 5 minutes.
Thank you, Mr. Chair. The first observation is that the ultimate solution to this is just to get rid of the debt limit. It's this thing, this ridiculous rule that we make up for ourselves. To that end, for the last several years, I've introduced, along with Senators Van Hollen and Schatz in the Senate, the Avoiding the Threat of the Default bill, which simply repeals the debt limit. I think this is the ultimate solution here, and I hope that we pass it before we get into some real crisis over this. Now, as the X date approaches, the exact treatment of different forms of Treasury debt becomes more and more crucial. There have been suggestions made, for example, that if the United States simply resumes issuing what are called consols, which are interest-only instruments, that since the debt limit applies to the face value of debt issued, that these would simply completely evade it, and there would be no limit on the number of consols that could be issued. Similarly, there are things called premium bonds that are sort of halfway between a console and a standard Treasury note. There's also the suggestion that so-called strips, which are apparently the secondary market, separates the principal payment and the interest stream as separately marketed and traded items. And if the Treasury were simply to hold auctions for only the strip part of this, there may be no legislative limit to this. And so I think maybe I'll ask you for the record, if you could go through this and see how what are the actual limits for the different forms of Treasury debt and how they relate to this. Mr. Driessen, I appreciate that, and we'll be asking you that for the record.
Sure.
Now, I was very struck by Figure 1 in the report that just looks at the historic debt. And, it sort of breaks my heart. This is a GAO thing. When you look at the greatest generation, they went out and they fought World War II, and then they paid down the huge federal debt of over 100% of GDP, or roughly 100%. And they paid it down in large part by adopting historically normal but very high tax rates on the very wealthiest among us. And so during the period that the U.S. economy became great and took over the leadership in the world, so we did that in large part by educating the next generation, in part by charging very high tax rates on the super wealthy. I believe that there was a long period of time when we had a tax bracket that only applied to one single family. And I believe that we have not, that tax policy did not destroy the wealth of that one particular family. And they seem to be doing okay last time I looked. And so that is the history of this. And then something changed in the 1980s. And frankly, I blame the boomers. That what happened, I'm a boomer myself, and the intergenerational wealth transfer here, I think, is really a very significant aspect of this. The long-term deficits are being driven by Medicare and Social Security and so on, a large part of which are boomers aging and showing up without assets at the end of their life. And a large part of the failure to have money to pay for that is because of boomers accumulating wealth. And I think the estimates are that over $80 trillion of wealth is going to be passed to the next generation by boomers as they die over the next 20 years. And so that there is enough money in our country to completely retire the debt. This is a point that was made by Donald Trump several years back before he controlled his messaging as well as he does, that by simply that there is enough wealth in the top few percent to retire our debt. And then what happens when you have these big, very high interest rate nightmares that people have? Most of the treasuries are actually held by United States citizens. Most of them, directly or indirectly, are pretty wealthy. And so that all the interest that would be paid in those scenarios, it's simply more wealth transfer away from the government of the people and into the pockets of the very wealthy. And so that we really have to understand that what's going on here is the boomers, basically greedy, wealthy boomers, wrecking it for the future generations. And the solution to that actually is within the hands of the boomers, is to simply go back to the tax policies that made the United States great, get rid of things like the basis step up and so on, and actually charge higher rates in a number of areas, particularly when that wealth is passed to the next generation. If 1/3 of the $80 trillion that wealthy boomers are going to be passing to their children, 1/3 of that would be enough to completely retire the federal debt. So let's just keep that in mind as this discussion goes on, and I yield back.
Gentleman yields back. The gentleman from Missouri, Mr. Luke DeMeyer, who is also the chairman of the Subcommittee on National Security, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I just can't believe what I just heard from our ranking member blaming the wealthy people of this country for our debt because they finance it. As my understanding is, Congress and the president are in charge of our debt. We make the decisions on how we spend money and where we get the revenue from. It's the people who have money who buy the Treasury bills are out there for a general purpose to be able to fund the government. This is backward thinking in my mind. Anyway, to continue on with the discussion here. Gentlemen, ever since mid-January when the federal government hit $31.4 trillion debt ceiling, Treasury Department deployed extraordinary measures to maintain payments on all federal obligations. We know these measures have taxpayer costs associated with them, and I'm sure they're not cheap. Either one of you gentlemen, can you tell us how much money that you project these extraordinary measures cost the taxpayers in direct costs that we have on the back end of this? I think, Mr. Arkin, you have in your testimony listed a
Yeah,
set of numbers.
we haven't looked at what the impact has been for this most recent impact. When we looked back for the 2011 impasse, it was in the range of tens of millions of dollars that it cost. And you know, the factors that were in play then were similar to now, but we don't have a number for what's.
Well, you were talking about in the billions of dollars in your testimony of direct costs.
So I'm not sure I mentioned that.
The economic costs, that's yet to come, but just the delay in contract payments and that sort of stuff, those kind of costs, you had a figure in you were listed several different entities, several different items there.
Okay. Yeah, I don't recall that number offhand, but we can get that to you.
Okay. With regards to recent bank failures reveal that there's a tremendous liquidity problem. And if you issue another $1 trillion worth of Treasury bills, it would have seemed to me that it would exacerbate that problem due to the continued increased cost of the rates on those Treasury bills. You know, the Fed, we've got a problem with inflation. You know, yesterday in the Wall Street talked about the lingering effects of the pandemic stave off the expected recession. There's about $500 billion still in the system that's got to be spent, or it's their extra savings, they called it, that's going to keep the economy going and keep it pumped up. So if that's the case, the Fed's going to have to come up with more increased interest rates, I would assume, to try and slow things down again. And these increased costs are going to have another exacerbating situation with regards to the banks. The Fed's already upside down on their rates. A lot of the banks are upside down, as shown by the 3 recent failures, and we have a number of banks that are still in a rather illiquid position. It would seem to me this is going to exacerbate the situation. Would you want to comment on that? Either one of you?
No, I mean, I think all I would say is that I think having 15 years of consistent interest rates at a given level, even if it's low, high, regardless, when you have a sudden change in those interest rates, it is going to probably lead to some form of economic disruption. In this case, it was interest rates that started very low and went up again at a pretty high rate. But outside of that, I don't have much to say.
Well, I think it's very concerning to me because in today's Wall Street Journal, they have an article there about big banks faced a boost in capital safety net. Because of this situation, the regulators are looking at a 20% increase in capital for the banks over $100 billion. And to me, it's directly responsible or tied back to this interest rate problem that is in our system right now. And I think it's going to be exacerbated by this increased debt that we've incurred. And so I'm concerned about all of how these things all fit together. And I just wonder if you guys had a comment on that.
I mean, in general, rising interest rates are a risk for the fiscal outlook. Historically, the last 20 years, interest rates have been around 1.5% of GDP. 30 years from now, that's up closer to 8.5% of GDP. And so you'll see, based on the projections at least, an increasing share of federal expenditures going to interest payments rather than to program spending.
Okay, I see my time's about up, and I saw what the chairman did to you guys, so I'm going to not do that to you. So with that, I'll yield back.
Gentleman yields back. Thank you. The gentlewoman from California, Mrs. Waters, is now recognized.
Thank you very much. Mr. Arkin, you devoted a considerable amount of discussion in the paper that you presented here today. That portion is entitled Debt Limit Impasses Disrupt Treasury Markets and Increase Interest Costs. And of course, when I gave my 1-minute presentation, I talked about brinksmanship. I want to talk about that a little bit more. In early May, Treasury sold $50 billion of 4-week T-bills that would mature in early June at a record 5.84%, which was the highest yield for any T-bill auction since 2000. In fact, researchers at Brookings found between mid-April and May 22nd, investors charged a premium of 1.4% on treasuries that were scheduled to mature in early June to account for the risks they would not be paid on time. Mr. Arkin, can you lay out clearly for the record how these premium increases end up costing the taxpayers money when this kind of brinksmanship that you described, this impasse, as you describe it, takes place?
Yeah, I mean, there are cost to taxpayers. What we saw on the secondary market were yields that rose pretty quickly in May from around 5% to 7%. There are also broader costs for other types of financing that is tied to the Treasury market. Things like mortgages become more expensive, car loans. So there is a broader impact on taxpayers and the general public.
And so this discussion paper that we have basically blames that increase on impasses. Is that correct? Is that what you're saying here?
It's a consequence of the impasse. It creates a lot of uncertainty. It does create risk. We've seen things like the market avoid treasuries that were supposed to come due on certain dates near the X date, which we've talked about, the date at which Treasury would not have enough funds to meet our obligations or pay our obligations, and that has occurred as we get closer to potentially breaching the debt ceiling.
Would you say that the recent impasse on raising the debt ceiling directly resulted in an increase in these premiums?
I mean, I don't know. As far as we've seen, and historically that's been the case, the uncertainty caused by whether Treasury will be able to meet its obligations.
Specifically, I want to know
default.
in this latest negotiations where there was brinksmanship, can you safely say that it caused the increase?
I mean, that's really why these, or our understanding at least, is that's why we see rates increase. That's why we see certain actions that the market takes, as it has in the past for impasses.
Going further, the Brookings analysis that I mentioned earlier highlighted that compared to 2011 and 2013, when similar brinksmanship over the debt ceiling occurred, the premium being charged by investors was much higher, and that it increased much earlier this time around. Would you agree with that?
I haven't looked and compared specifically what happened this time around versus in 2011 and 13, but we can get back to you on that.
Well, specifically, they found that the premium being charged was more than 4 times larger this time than past debt ceiling debates, when they observed a 0.3% premium, and it began several weeks earlier. Does this mean that this time it will cost taxpayers more? And if so, how much more would you expect?
Again, we haven't looked into that. I wouldn't want to hazard a guess in terms of what the cost was or what the change was. It's, what we've done is really based on past.
Is there any plan to look into this so that we can make a determination about the costs
It's something that we'd be happy to talk to you about, talk to your staff about what GAO could do to help support you with those questions.
Thank you, and if it's okay with the chair, I'd like to see the result of your looking into it, to see exactly what happened and how it differed from what happened in the last negotiations for raising the debt ceiling. Thank you very much. I yield back.
Gentlelady yields. The gentleman from Georgia, Mr. Loudermilk, the vice chairman of the subcommittee, is now recognized for 5 minutes.
Well, thank you, Mr. Chairman. Thank you both for being here today. Mr. Arkin, in your written testimony, you included a graph representing simulated growth in the public debt as a percentage of GDP. To summarize the graph, the GAO and CBO estimate that the U.S. public debt would reach 195% of our GDP by 2053. Understanding that, how would the effects of this sharp increase be felt between now and 30 years from now, assuming Congress doesn't act to cut spending and reduce the deficit?
Sorry, I turned it off. Yeah, that's what the projections show, a pretty steady increase in debt to GDP. You know, there are risks with that. There's always the potential of some fiscal crisis where interest rates would rise pretty quickly. And I think the difficult part is no one really knows how much is too much or at what point does it become problematic. And what we have suggested is that Congress develop a plan to take a look at what would be an approach that would allow us to manage the debt in a way that brings that ratio down a little bit, or at least keeps it stable, looking into the long term.
And so when I first got to Congress, I believe we need to balance our budget. I don't know that in modern times that we have the political will to do that. That's why I think we need a constitutional amendment to force us to do that. And I think we can get there. But I noticed when I first came to Congress that every budget that we were passing as Republicans balanced within 10 years. I was impressed by that. But then the next year, we passed a budget that balanced within 10 years. And every year, we're passing a budget that balanced in 10 years. We never decrease that. And so it seems like that with a long-term plan that we stick to, is what I think you're alluding to, that we would be able to lower that curve. Is that correct?
Yeah, I think so. And that's really the gist of it, is having a plan with a target where you can look at revenue, you can look at spending, and have those be a little bit more imbalanced so you're not driving deficits that drive debt that grow faster than the economy.
In fact, I have a bill that I've introduced every Congress, and I'll be introducing it, I believe, this week or next, which is a balanced budget amendment to the Constitution that requires Congress to balance within 10 years. And so I hope I can get support from that from both sides. Still on the debt issue, a significant portion of the U.S. public debt is held internationally. Other countries with high levels of public debt to GDP, such as Japan, they hold most of their debt domestically. What challenges would high levels of foreign-held public debt create if our GDP reaches the extreme of the GAO's graph? And would there be a difference if more of our debt was held domestically?
You know, we haven't looked specifically at whether there are risks to foreign governments holding a share in terms of with growth in that ratio in the future. I'm not sure if you have.
Yeah, I mean, I think I think that's one change in recent debt patterns over the past couple of decades. I think it's been something like gone from a share of foreign held debt held by the public for U.S. from about 10% to like 30% or so as of right now. I think people who support the idea of allowing foreign individuals or institutions to hold our debt would say that it helps lower our interest costs. Essentially, by having more people who are willing to buy it, you can lower your price. There's a cost of that, right? The interest payments are exiting our economy and going into someone else's economy. And so that can be viewed as somewhat costly if you're thinking of that.
Taking it a step further, and if you don't know the answer to this, that's fine, but thinking forward on this, should we have defaulted, does that create some type of national security risk that so much of our debt is held foreign that somebody like China could step in, purchase that debt from others? I mean, what impact would that have on our economy, on national security?
We've looked at this a little bit and found that the risk at present is pretty low, only because I think the holding of all of that debt is relatively dispersed. Treasury does have a table that it produces monthly, estimating how much of our debt is held across countries. And you can see that I think the top holders hold a little bit more than $1 trillion, which is still quite a bit of money, of course, but there's not kind of one single country that's holding the majority of our debt in terms of the total debt that's held across the world. And so even within that country that's held by lots of different people, and Treasury is turning over lots of its debt as part of its regular process, typically about 2/3 of its debt in a given year, or at least in recent years. It's certainly possible, but we've looked and we don't think it's a huge risk at the moment.
All right, thank you. I see my time has gone away, so I'll submit the rest of the questions for the record, and Mr. Chair, I yield back.
Gentleman yields. The gentlewoman from New York, Ms. Velasquez, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for having this hearing, and thank you for being here. As we are discussing here this morning, long-term projections show that the federal debt as a percentage of the economy is on a path to grow indefinitely. My colleagues on the other side of the aisle constantly use this fact to call for dramatic spending cuts, just as they did last week. And this call for cuts consistently harm our nation's most vulnerable. However, when House Republicans talk about the debt, they frequently fail to acknowledge the true cause of the debt level rise. And that is the fact that for the past 25 years, under Republican leadership, they have slashed taxes that primarily benefit the wealthy and profitable corporations. This has led to a lack of revenue and put us on a path of uncontrollable debt. According to a recent analysis by the Center for American Progress, it is, if not for the Bush and Trump tax cuts, revenue will be on track to keep pace with spending, and the debt will actually be declining. Instead, these tax cuts have added a dramatic $10 trillion to the debt since their enactment and are responsible for 57% of the increase in the debt ratio since 2001. So when we talk about the debt, it is important we talk about the facts and what is actually fueling our debt. Mr. Driessen, according to the Center for American Progress analysis, there has been a decrease in non-interest spending of more than $4.5 trillion over a decade since the Bush-era tax cuts became permanent. But the drop in revenue was 3.5 times as large, the equivalent of more than $16 trillion over a decade. Would you agree with the assessment that while projections of spending have decreased, the projections of long-term revenue have decreased even more?
I think if you look at recent CBO projections, which are public record, you can find, I think, similar facts there. I mean, so CBO just put out an alternative fiscal scenario in their baseline. They have both spending and revenue alternatives that they consider, but I know they also look more closely at the 2017 tax law and some alternatives there, along with some spending.
Thank you. Mr. Driessen, the CBO recently estimated that extending many of the temporary provisions in the Tax Cuts and Jobs Act could cost as much as $2.7 trillion and increase the debt as a share of GDP by 2032 to as much as 118%. From a budgetary perspective, does it make sense to consider another large TCJA 2.0 package extension when the federal government already seen a revenue shortfall?
I mean, I think I would agree with my colleague here that we have a kind of a structural imbalance with the federal budget. Mm-hmm. And I think most folks just looking strictly on the debt side are relatively impartial as to how the federal government changes its operations, whether that's lower spending, higher revenues, or some combination of the two. Okay. But I think it's up to the federal government to decide what it would like to do. I
take that as a no. Mr. Driessen, some people like to argue that large one-time spending packages in response to a financial crisis or public health emergency add to our deficit. But they are just that, one-time costs. Can you explain how one-time spending packages in response to a crisis do not increase the rate of growth in debt over the long term?
Sure. I mean, I think a general economic theory would suggest that in a severe recession, increasing your net deficits wherever you're starting from might be advisable, essentially to kind of stave off some of the spiraling effects of an economic crisis. And even if you were looking strictly from a debt perspective, if you let a recession get too large, the deficit effects on their own, absent congressional action, would get quite large and would lead to increasing debt. So that counterfactual could be kind of what you're speaking to.
Thank you. Mr. Chairman, I yield back.
Gentleman yields. Gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. It's really troubling that there's not agreement that there is something such as too much debt. I don't understand how we're having these conversations. I ran for Congress 5 years ago, and debt was literally the #1 issue I ran on. Unsustainable fiscal policy in Washington, D.C. was spending us into oblivion. It's immoral to mortgage our children and our grandchildren's future. So I guess the first question I have for both of you is, let's just say 200% debt to GDP ratio. What would happen if we had 200% debt to GDP ratio, Mr. Driessen?
I mean, I think something we could say with more certainty, and which is shown in the projections, is that you're spending more and more, devoting more and more of a portion of your present budget to interest spending, so essentially paying off past choices.
Would it be bad? Would it be adverse to the U.S. economy? Would it be adverse to the American people?
So this is something where the field of economics is pretty unhelpful in terms of identifying the exact number for you, but the risk of a debt crisis at that level is certainly higher than it is at 100, the way that it is
When
now.
Greece went into austerity measures, what were they at? 180%? Is that
Yeah,
correct?
they were relatively low. The alternative is that Japan is currently at 260 or so, and that's certainly a country that we're looking at. Demographics, their structure is of interest.
So historically, we've only seen the amount of debt that we have right now. World War II?
Right after World War II, that's right.
And why did we create that much debt? Because we fought a world war. We sent hundreds of thousands of soldiers all over the world to save the world from communism and chaos. I mean, so that was the justification then. What is our justification now? We don't really have one. I mean, we've created a system that's unsustainable. The largest drivers are off limits. We just had a debt ceiling fight, and we only discussed 11%. 11% of the budget is all that was discussed. We didn't discuss healthcare, where we have the highest obesity rates, the worst outcomes of any developed countries, and we spend 3 times the amount per capita. We have a healthcare problem. We have a workforce problem. We have millions and millions of people in this country illegally, and they would love to have a job, but we have a broken immigration system. We have an unsecure southern border, and we refuse to address that. And then we have Social Security. So if we do not take steps to save Social Security, we will become insolvent. 7 to 10 years? Is that the projections?
Yeah, I think for Social Security, 2033, so that...
Every year that passes, does it get harder to fix?
Yeah, the longer we wait, the more, the more severe the changes will need to be in order to stay solvent.
So, I mean, the 3 major drivers of our debt, healthcare, immigration, and Social Security, were preemptively removed from discussion by our leaders. And I think that's unacceptable. At the last minute before our vote last week, we heard some talk about a commission on debt. Hopefully that will come to fruition, but at the end of the day, it's immoral to spend our children, our grandchildren's money. At this point, we're spending our great-grandchildren's money, and we need to find a way to get the political courage to save Social Security, to have a healthier population so they can work and pay taxes. And to address immigration. We're not going to tax our way out, and we're not going to cut spending. We need to grow the economy, and we need to resolve the challenges that our current entitlement programs are facing, because if we don't, they're going to fail. They're going to fail. And our solutions get harder and harder every year that we do nothing. So I just hope that we can find some courage in this great Congress to address the real challenges that are facing our spending and to get our country on a more sustainable path so we can continue to be the beacon in the world and lead in the global community because we have done so much good over the last 100 years and we have more to offer. And if we do not get our fiscal house in order, that will come to an end. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Mr. Chairman, at the outset, I'd point out that it's a rule of the committee that before we mark up a bill, we consider it at a hearing. It makes a mockery of that rule if we list bills as getting a hearing here today when those bills have virtually nothing to do with today's hearing. A few of the bills listed today change how much retailers will pay credit card processors for processing credit cards. One of the bills would diminish the authority of the CFPB. I would hope that we would not view those bills as having had their required hearing at this committee when we have witnesses here that are focused on the federal fiscal situation. We did not dodge a bullet. We just avoided a fatal wound. As Mr. Arkin has pointed out, interest rates are higher than they would have been otherwise. But the bigger issue is that America is competing for capital that we need to build our businesses and do our research with the rest of the world. And from London or Paris or Tokyo, we have made America look like a bozo, clown car, chaos, calamity. Who'd invest in this? Furthermore, the US dollar plays this critical role in the world. China is trying to displace it. And how do we make the argument that the US dollar should be the linchpin of every economy in the world? We come close to pulling the linchpin out. And that role in the world is so critical. Our sanctions policies have been effective when they have been effective only because of that role. I remember when we told other countries how much oil from Iran they could purchase, and they agreed to it. But the wealth of American families would be dramatically undercut if we are not playing this role in the world. We spend money like Democrats. We tax like Republicans. We've got a debt that would make Argentina blush. And as Mr. Arkin points out, we're headed for levels that even we cannot sustain. I think the Republicans took the wrong hostage. We have reached a deal on spending levels. We should have reached that deal in the context of talking about spending for a fiscal year begins October 1st. Instead, in an effort to get our spending deal, we threatened the poorest people of this world with a worldwide recession, people who are making it on $1 a day, and we put them in a position where they might have to make it on 2 meals a day, and death rates might have to rise the whole country because we can't get our act together. That's the wrong hostage to take. The chairman says that the banking problems faced by 3 banks are the result of the Fed mishandling things. Mr. Jay Powell was first appointed by Mr. Trump, reappointed to a higher level by Mr. Biden. 5% interest rates is not something that banks should be unable to deal with. Under Ronald Reagan, they dealt with 16%. And in fact, most banks have dealt with this. The 3 worst run banks didn't. Keep in mind that Silicon Valley Bank had hedges against rising interest rate. They sold the hedges, made money by selling their insurance policy, recognized profits, paid bonuses on those profits to their directors, and especially their management. Mr. Arkin, I realize it's tough to look at, in effect, counterfactuals, but are interest rates going to be higher over the next year or 2 or several years because we came so close to shooting ourselves in the head? Fitch has us on a downgrade watch list. Is there any way to determine or even quantify how much higher interest rates are going to be for the next couple of years?
So I don't know whether there's an immediate impact on interest rates from the impasse. In general, interest rates are expected to increase in the future, certainly from where they were a few years ago.
And is there any other country, other than Denmark, I think, that I'll ask you to respond to the record, who has this debt limit process?
Gentleman's time has expired. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized.
Thank you, Mr. Chair. I just wanted to comment, I think Mr. Sherman maybe missed the point. I mean, a lot of the bills that we're looking at today kind of feed into the overall discussion that I think is happening, so I think I would disagree with that. Following the financial crisis in 2008, we saw several Western countries, especially Greece, which really was stark. I remember talking to a friend of mine who had been traveling and had been to Greece and actually experienced the idea of having to go to an ATM to get some type of currency, and it was shut down. It was unavailable. So we kind of think of this, I think, in an abstract, that a lot of the issues that we're facing right now, couldn't happen here. It's just not believable. But I think it is, and I think it's real, and I think that's what this committee is trying to focus on. So a common problem was the leverage. It was transferred from individuals and institutions basically to the government. And obviously, the United States is in a different position because we have the dollar as a global reserve currency, as been brought up many times today. The CBO estimates the U.S. federal debt could reach 195% of GDP by 2053, so a different date than what we were talking about earlier with Social Security. But, Mr. Arkin, how long do you think we can maintain, or God forbid, keep adding to this level of debt before we experience a debt crisis like some of the smaller European countries have already faced?
Yeah, I think we talked about this a little bit earlier, but it's a bit of an unknown. I think the thing that we focus on is the risk involved with that ratio going up and up and up. But what that number is really not known, and that's why I think we're trying to emphasize the importance of having a long-term plan now that will look out 30 years in the future, and what kind of revenue, what kind of spending policy would put us on a more sustainable fiscal path.
Yeah, and my second comment, I guess, would be, if you remember when President Clinton was here and we had the increased revenue, you can argue some of it created by the dot-com and other high-tech industries that just exploded in the 90s. But at that point, there was kind of this idea that there was an ebb and flow related to the debt. So what would you say are the signs now that we've kind of moved away from that and we can't rely as members of Congress on the idea that suddenly there's going to be this, complete shift in the economy that's going to bail us out at some point?
Yeah, I think, you look historically, and average debt to GDP over time was more in the 40 to 50% range for many, many decades, and it's really the last 20 plus years or so where that's changed, where it's just gone on an upward trajectory.
Yeah, the only thing I'd add is in the 90s, when you look at old age and retirement programs, you had kind of the boomers that were entirely working, right? This historically large population that was feeding into some of those trust funds and a smaller generation taking out. And then another thing that's happened in recent decades has been healthcare costs that have grown faster than the economy at large. It's a thing that we're kind of trying to figure out is going to continue or not, and that wasn't quite as pronounced at that time. So I agree that the economic boom at that time was also contributing to the declining debt to GDP, but those kind of old age and retirement programs were in a different phase, you could think of, as opposed to now.
Right. My final comment would be, if you read, there's been a number of articles written about the red tide, which is simply the debt is going to continue to grow, obviously under the generation that currently is moving through our population. Medicaid is still the ultimate driver of that debt. I mean, there's a lot of focus on Social Security, but it's still Medicaid and the growth there as related to the costs associated with that continues to just balloon. So I think oftentimes Social Security and Medicaid get lumped together in this discussion, but that's not really accurate, is it?
Yeah, I think that the biggest driver looking into the future are federal healthcare programs in terms of increases in spending. You do have the aging of the population that affects Social Security on Medicare, but as Grant mentioned, it's kind of this excess cost of healthcare, above the rate of inflation that really drives things in the future.
And then also interest costs. I mean, when you get 2 and 3 decades out, it's really the interest costs, something we don't really control very well. That's more set by kind of international economic outcomes.
Thank you. Thank you, Mr. Chair. You back.
Gentleman yields. Gentleman from Texas, Mr. Green, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing. Mr. Chairman, as we look for new ways to extort capitulation, to avoid negotiation, and to protect the wealthy from paying their fair share of taxes, let me share a few thoughts. First thought is that I associate myself with the remarks of Ms. Velasquez. I think that she made some salient points. But I'd like to introduce in the record an article styled 50 Years of Tax Cuts for the Rich Fail to Trickle Down. Economic study says, tax cuts for the wealthy have long drawn support from conservative lawmakers and economists who argue that such measures will trickle down and eventually boost jobs and incomes for everyone else. But a new study from the London School of Economics says 50 years of such tax cuts have only helped one group, the rich. A second article, trickle-down tax cuts make the rich richer, but are of no value to the overall economy. President Trump sold his 2017 tax cuts as rocket fuel for the economy, arguing that freeing up money for the wealthy would allow them to hire more workers, pay better wages, and invest more. The tax savings, in other words, would trickle down from the rich to everyone else. But just as many economists predicted, slashing individual corporate and estate tax rates was mostly a windfall for big corporations and wealthy Americans. The Tax Cuts and Jobs Act did not pay for itself, failed to stimulate long-term growth, and did not lead to sustained business investments. This, by the way, is from the Washington Post. The previous article was from CBS.
Without objection.
Thank you. And Mr. Chairman, there seems to be a belief among many of my colleagues on the other side that the rich need and require more to do more, and the poor can do more with less. We continually find my colleagues finding ways to cut taxes for the very wealthy that only benefit the very wealthy. In our lifetime, we're likely to see the first trillionaire, people who are capable of having their own rockets to traverse great distances in space. Poor people need Medicaid. Working people need Social Security. As long as I can cast a vote, I'll be casting a vote to protect Medicaid, Medicare, and Social Security. People who work for a living deserve the opportunity to have good health care and a retirement. This is all important, friends, because if the wealthy fail to pay their fair share of taxes, this decreases the amount of revenue that we have to pay our debts. We have to require more from those who have much. And I would add this: cutting the IRS agents, as it was said, by cutting the taxes that were collected so that we could pay for persons to examine the wealth of people and catch those who are cheating, who are wealthy, eliminating those agents was not a good idea. Why are we going out of our way to make sure that the wealthy can cheat? Why do we go out of our way to make sure that the wealthy can pay less than their fair share of taxes? And to those who would say they pay more, they may pay more in some percentage, but they are making a lot more as a percentage of the wealth. It's time to cause the wealthy to pay their fair share of taxes so that we can pay our debts. I yield back.
Gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized.
Can't help but respond with what I've learned about socialism, communism, Marxism over the years. And it seems like they want every single thing you have except your job. There seems to be a lot of confusion about what actually a default is. Strictly speaking, can you distinguish anything between a default on a debt as opposed to merely not having sufficient cash flow to sustain expenditures at the level authorized in the Appropriations Acts?
Yeah, I think you're referencing kind of what it would mean if we actually hit the debt limit, and default meaning not being able to pay existing securities that we have versus unable to meet existing spending obligations. There is a distinction, I think, there that could matter for particular federal programs. I'd only add that I think the economic effects of hitting the debt limit and paying existing principal and interest on securities, but not being able to make other contractually obligated spending requirements probably would have some pretty large economic effects, as best we can tell.
Comment?
Yeah, I mean, I would agree with that as well. I mean, there are distinctions, but rating agencies and others, in terms of what we've seen, would think that there's going to be an economic effect to it either way, even if there's a distinction between paying debt and maturing securities versus other federal expenditures.
How much is the interest on the debt now costing taxpayers, and what % of total federal expenditures is that? And how is it being projected to grow over the next 5 years?
I think it's something like $700 billion this year, or about 10% of spending, maybe 2.5% of GDP. Do you have that?
Yeah, I think the end of 2022 is about 8% of total federal spending. The last 20 years or so, it's been 1.5% of GDP. It's gone up a little bit, but based on our projections, by 30 years from now, it's more like 8.5% of GDP. And then you go out, 75 years, and it's quite a bit more in the 20s, I believe, 23% or something like that. And that's really a consequence of continuing to issue debt at a rate faster than the economy grows.
Okay. If the Federal Reserve hadn't been buying the federal debt and increasing the money supply, wouldn't the interest rates have had to rise on their own to sell the debt to the public? And wouldn't that have helped prevent our record inflation?
Yeah, I'm not sure that I could comment definitively one way or the other, just because the Federal Reserve is such a large actor, and it would have kind of other indirect economic effects, I think, outside of that direct effect.
Yeah, likewise, I don't have a comment on that.
Some people believe that in an instance where the Treasury couldn't borrow more money, they should be able to prioritize the use of the cash and reserves that they have to pay the most important items and even curtail some expenses. Secretary Yellen disagrees and says that she wouldn't do that. If most people got in a bind and couldn't increase debt, they'd have to choose who to pay and stop incurring some expenses. Any idea why you think government couldn't do that?
Yeah, I think there's a distinction, I think, between making payments on existing securities, principal and interest, and kind of making choices with existing spending programs. And so from a kind of a legal standpoint, I think the Treasury's mandate to minimize federal borrowing costs, there might be some support for prioritizing principal and interest on existing securities. That's what we understand they were at least strongly considering in 2011 when we got really close. And from a practical standpoint, they they actually make those payments in a different system than they make all other federal spending program payments. When you look at prioritizing current spending programs, that's been a matter of some debate for decades as to whether or not there's legal justification for Treasury to prioritize some payments over others under current law. And I think there's also this practical component where they're not sure if they could do it. I can't really speak to Treasury's capabilities in that way.
You agree?
Yeah, I would agree with that.
Some economists say that financing our recent deficits by selling debt to the public would have contributed to crowding out our private sector investment and thus reducing the stimulus of bills like the American Rescue Plan. Do you agree with that?
I think that's one of the things you see with or read in the economic literature about increasing debt is it can crowd out spending in the private sector.
Gentleman's time has expired. The gentlewoman from Ohio, Mrs. Beatty, is recognized.
Thank you, Mr. Chairman and Ranking Member, and thank you to the witnesses for being here today. First, let me just say I'd like to echo my colleagues' sentiments about the irony of this hearing being held this week, a week after our economy nearly imploded. When Ranking Members Waters and other members of this committee have been asking for a hearing on the impacts of a debt default for months. It's also very interesting that as many of my colleagues are talking like this is the first time that we have experienced that, certainly we know that the debt ceiling was raised 78 times from 1960 to 2021. 18 times under President Reagan, 8 times under President Clinton, 7 times under President George W. Bush. And we also know, when I came to Congress in 2013, we also raised it. We had the No Budget, No Pay Act. We also know in the last administration, without any fanfare from Republicans or Democrats, under the last president, we raised the debt ceiling 3 times. So here we are today. Maybe we're putting politics over people. We have a colleague on the other side said that he ran on this and Social Security. Well, he had a chance last week when he voted against it, and Social Security was a major part that we were fighting for Social Security and Medicare and Medicaid, and even to some degrees health care when he talked about that. So it's very interesting to me that we're sitting in a committee hearing where we're talking about, and we have Republicans in charge, and yet thank goodness for Leader Jeffries that it was the Democrats and not the Speaker and his colleagues that were able to save the debt. So I want to be on record of certainly applauding that we were able to uphold our debt. So let me move on, Mr. Arkins, as I'm on the National Security Subcommittee, and we're holding a hearing tomorrow entitled Dollar Dominance, Preserving the U.S. Dollar Status as the Global Reserve Currency. Now, since we're bringing you in here to talk about the debt and to talk about Treasury, let's just go through and play this game. If we were to default on our obligation, what would be the impact of the U.S. dollar status as the global reserve currency?
I mean, it's not something we've looked to in depth. It's something where if other countries look to start holding other currencies rather than the dollar, that could have an effect on the dollar's supremacy in foreign markets.
And since we're talking about China and how China and the strength of the U.S. dollars, but yet our actions, we were going to default just last week. So what would that do with our relationship to other countries, and how would or would that not put China in a better position?
Certainly the expectation is that it would have had a very negative impact on the economy, which would put us in a worse position.
And in your opinion, would that have affected health care? As my colleague said, we care so much about health care. Would it have affected housing? Would it have affected small businesses? Would it have affected many of us sitting right here?
Yeah, it could have certainly spilled over into the broader economy. Certainly, activities that rely on financing that's tied to treasuries, mortgage markets, other types of lending would likely have been affected.
Okay, thank you. With the other, Mr. Driessen, would you like to add anything to that?
Yeah, I mean, I think there's a lot of uncertainty as to what the total level of that sort of effect would be if we lost our kind of status as the preferred reserve currency. I think one estimate that I've seen is it saves us something like 1/4 percentage point on interest rates. And so CBO estimates that would be something like $50 billion per year and $500 billion over 10 years. And so if we lost that status, we would just pay more in interest costs, and so we would have less to spend on all sorts of other things.
So, to both of you, do you think it was a good thing that we did negotiate and come to a deal where Democrats were able to deliver on the votes and we were able not to default on our debt? Was that a good thing that we didn't default, yes or no?
Not defaulting was probably good for our economy, yes.
I agree.
Thank you. I yield back.
Gentlelady's time has expired. The gentlewoman from California, Mrs. Kim, is now recognized.
Thank you, Chairman. For nearly 100 days, President Biden refused to sit down with Speaker McCarthy to negotiate the debt ceiling agreement and get our fiscal house in order. And since 1985, the 8th largest deficit reduction laws were attached to debt limit legislation. So any attempts to portray the debt ceiling negotiation as a Republican effort to hold our economy hostage does not responsibly provide the public with the historical precedent. The recent historic bipartisan agreement reached showcases that Congress can act on that precedent to implement deficit reduction policies. So in February, the CBO estimated that annual net interest costs would total $640 billion in 2023 and more than doubled over the coming decade to $1.4 trillion in 2033. So it would be irresponsible for us not to address the unsustainable debt and do good for our grandchildren and their children. I agree with Representative Beatty about her comments regarding reserve currency. The US dollar enjoys a reserve currency advantage over competing foreign currencies, which provides benefits to the United States in several ways, including trade, finance, and in financing our unsustainable debt. Fiscal uncertainties or debt limit impasses threaten investor confidence in the dollar as reserve currency. And I want to ask both witnesses the question. If the US continues with spending growth outstripping overall economic growth and the resulting unsustainable debt trajectory, which cannot be solved with higher taxes, is there a risk that the United States could lose its reserve currency status?
I think there is a long-term risk. I think that we are talking about that the debt is on an unsustainable path. I should also point out that organizations look at the short and medium-term risk of the federal debt, and they find that to be pretty low. But structurally, we are on kind of a rising path, and at some point there could be kind of an effect on that reserve currency status.
Sure.
Yeah, I would certainly frame it in terms of a risk and something that would have downside if that were to happen in the future.
Well, the Treasury general account is nearly empty, and it needs to be replenished. According to an Axios report, the government will likely need to issue as much as $1 trillion in Treasury bills over the next 6 months to return to the balance to historical norms. So can you tell us how Treasury will manage that sudden influx of treasuries into the market? And do you know how Treasury is assessing the possible risks of sudden wave of treasuries flooding the market?
It's not something we've looked into immediately. I've read similar things, and in particular, a lot of that debt may be in short-term notes, which has some impacts, but I don't have a complete answer right now.
That's right. I think it's fair to assume that as in their capacity, Treasury was planning for this scenario, right, an agreement right around when the debt limit would bind and would need to kind of plan for auctioning more securities than they otherwise would, but I don't know the exact details of that plan.
What do you think should be done?
I'm sorry, can you say that again?
Well, I'm just asking you, I know we're hearing the same thing, but you said there is no, plan on that sudden influx of Treasury. So I'm asking you, what do you think Treasury should respond to that?
Treasury does tend to carry a cash balance that's in the hundreds of millions of dollars to manage some of the uncertainty that comes from day to day or week to week payments and inflows of revenue and expenditures. And so, they do having the cash balance come down to in the $30 million range, need to build that up fairly quickly. So I wouldn't say it's an unexpected reaction on their part.
Yeah, and I'd add with the cash balance, the recently enacted law now moves the next debt limit episode 2 years up. And so the cash balance, in addition to the extraordinary measures, is what kind of fuels that extraordinary measures length of time, and that might also be something that they consider when they consider the cash balance.
Lastly, I know a lot has been discussed over the X date, right? So why is it so hard for Treasury to forecast and pinpoint that X date, and what makes it so hard for Treasury to provide that extra data to Congress?
Yeah, I mean, in the medium-term picture, it's a lot of its revenues, not knowing exactly when people will file their taxes and how much they'll pay.
Unfortunately, the gentlelady's time has expired. Would love a more fulsome answer, if possible. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. First, I want to thank you for holding this hearing. I think it is a very important hearing. I want to thank the witnesses here today and, of course, the ranking member. A colleague of mine said that Republicans have constantly banged on the debt limit. That's actually not true. I'm going to challenge that premise. I didn't hear a peep during the presidency of Donald Trump. There were 3 or 4 Republicans that said something, but the rest weren't fighting the debt limit. I didn't hear anything. I was here. Crickets. They only fight it when the Democrats are in charge. All of a sudden, they become deficit hawks. They certainly didn't do it when President Trump was here. Now, I think that what we just had was a artificially created crisis because of this debt limit. But there were some positives to it, just to be frank. I mean, Republicans, thank them to make our president look strong and bipartisan and wise. I think that was one of the outcomes. So certainly there was something positive for America there, and we thank them for that. It was very much appreciated. Thank you very much. Also, World War II was brought up more than a few times. And just to correct the record, World War II was not to fight communism. They were on our side that time. Remember Uncle Joe? Soviet Union? We were actually fighting the Nazis and fascism, just for the record. Because they said we were fighting communism. No, they were on our side that time. I don't like them now. I'm not a communist myself or a socialist. But just for the record, I think we get those things wrong. But since we were talking about World War II, President Eisenhower becomes president. What was the highest marginal tax rate during his presidency? Do you know?
No, I don't know offhand. It's higher substantially than it is today, but I don't know the actual number.
How high? Take a guess. You don't know. How about you? Can you help him?
I want to say in 90, but I'm not sure.
91%. 91%. So I ask you, was he a communist, trying to take everything away from everybody except for their job? I'm asking the question.
So my knowledge of President Eisenhower is relatively limited. I don't know the answer to that question.
Yeah, I don't think he was a communist. He worked well with the communists at the time, with Stalin and, of course, the Soviets that they were attacking the Nazis, but he was no damn communist. Of course he wasn't. Now, I do want to ask this. In 1999, November of 1999, a prospective candidate for the Reform Party presidential nomination made a proposal to tax people in trust with wealth over $10 million, 14.25% to wipe out the national debt. Do you know who that candidate was?
I do not.
No, but I can't wait.
Shocking that you don't know, because he became president as a Republican. Donald Trump. Donald Trump did. Donald Trump's plan to wipe out the deficit, which I think back then was like $5.76 trillion, something right around in that area, was to tax wealthy people and trusts to wipe out the debt in one fell swoop. Just out of curiosity, is he a communist? Is he trying to take everything away from wealthy people except for their job?
Also not an expert on that.
What's that?
I'm also not an expert on that.
I would hope not. Well, thank you very much. I do want to get now to that X date. I was very curious about that too, because it changes, and sometimes it changes pretty dramatically. The first thing that I caught was that that big number that you said, suspension of the reinvestment in the government. Now the fun part's over. The reinvestment of the government securities investment fund, $294 billion into the federal employment retirement system. That actually is quite a chunk of money, and that seems to give quite a bit of headroom.
That's right, yes.
So is that one of the things that confused you? You were talking about taxes, but also these payments. I mean, that's a big payment. If you can delay that, I mean, that's quite a lot of money.
I think it was less about the size of the extraordinary measures themselves, and it was more about the changes in what kind of from day to day we'd be bringing in and spending.
Okay. Well, I just have 20 seconds left, so with that, I'll yield back and thank the chairman.
The gentleman yields back. The gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you, Chairman Barr and Ranking Member Foster, for holding the hearing, and thanks to our witnesses for being with us today. Mr. Driessen, Treasury securities are backed by the full faith and credit of the U.S. government. Investment professionals use Treasury yields as the risk-free rate or the rate of return offered by an investment that carries no risk. T-bills are considered zero-risk investment thanks to Treasury and market liquidity and the creditworthiness of the United States. However, as we saw with the recent bank failures, T-bills become less attractive to investors when interest rates rise. So my question is, should we still be assigning zero-risk weights to T-bills?
I mean, I think that's for the market to decide and not for us to decide, although I will agree that that is one of the risks to a binding debt limit.
And during the recent debt limit episode, some officials contended that if the debt limit were to constrain the government's ability to meet its obligations, that would be an unprecedented blemish on the nation's credit, and that the U.S. has never defaulted. But isn't it true that the U.S. has actually defaulted at least 3 times? The War of 1812, the 1933 suspension of the gold standard, and the 1979 when Treasury failed to make timely payments to some small investors.
Yeah, there are some questions on various points in time as to whether or not the federal government has defaulted. I think probably an accurate thing to say is we've never failed to raise the debt limit when the debt limit has been close to binding, but that's correct.
Sure, and is it fair in your mind to characterize increasing, if that was to happen, and I don't mean to be overly provocative, but to characterize that as default when in fact the United States would continue to have capacity to make, to prioritize payments and indeed pay creditors, if you will, or those holding U.S. credit obligations. Do you think that term is accurate?
I think it's true that from a legal perspective, default means something quite precise, and that an option that could be available to Treasury in a binding debt limit is to avoid that precise default definition. There could be large economic consequences with a binding debt limit with or without that being met.
And so wouldn't, in fact, if we failed to extend the debt ceiling, and I'm just interested in your perspective on this, but wouldn't that look more like what would happen if a average American didn't have enough money to do everything they'd planned to do, but they had enough money to pay all their really important bills, and maybe what they had to do was quit spending as much? Wouldn't or couldn't that, in fact, be the scenario that would, at least in the short term, play out?
I always get in trouble with my colleagues if I compare the federal government to an individual bank account. That said, I think that some of the spending that is on the books is contractually obligated. I mean, we've assigned to do that, and if we don't meet those contracts, that could be another name for default, but it would be viewed as something similar, perhaps by the markets as well.
And while I'm at it, I want to pursue the question as it relates to Social Security payments that ostensibly come out of the trust fund, and I realize that the reserves in the trust fund, obviously we have incoming receipts on a regular basis, but we also have payments, interest payments and principal payments that are recurring or coming to the trust fund. Wouldn't those payments be secure to the extent that current tax revenues would support payments and to the extent that the government was actually able to continue making interest payments and principal payments to the trust fund?
I think it's relatively uncertain just because we haven't done it before. There's an understanding that it's possible that those will be affected just along with all other payments.
And when there's a sudden influx of money into the economy, such as when the government prints more money or creates money through open market operations or through quantitative easing, in your view, does that generally cause inflation?
I wouldn't want to hazard a guess to comment on that. Thanks.
Okay, thank you. Mr. Arkin, could the Treasury be more transparent, or should they be more transparent in sharing information about debt, cash balances, forecasts on how long extraordinary measures would help keep debt below the limit, forecasts of near-term receipts and revenues in cash, or forecasts about the X date? Do you think more transparency would be positive?
You know, I think Treasury generally has responsibilities to share information with Congress. I think with the X date, with extraordinary measures, they kind of balance that in terms of the information that's provided to the market, given that it's a very sensitive topic.
Well, and maybe for the record, wouldn't it be helpful if we all understood how they calculate the X date? Thank you. I yield back.
Gentleman yields. Gentleman's time has expired. The gentleman from Illinois, Mr. Caston, is now recognized.
Thank you, Mr. Chairman. I want to start, I just want to clarify a couple points that Mr. Sherman made. Were either of you in preparation for this hearing asked to testify about increasing the exemption threshold for mid-sized banks?
No.
No. Were either of you asked to testify about changing the mechanism by which the Federal Reserve is funded?
No.
Were either of you asked to testify whether the FDIC should be funded with par value securities instead of cash, shifting liquidity and interest rate risk onto the FDIC away from banks?
No. No.
Okay. This hearing is ostensibly about concerns about opacity of the Treasury, and in the interest of transparency, let the record show that 3 of the bills noticed in this meeting have absolutely nothing to do with what the witnesses were brought here to testify on. If we care about transparency, if we care about a fulsome debate, let us insist on the same transparency in this body that we seem to be concerned about at the Treasury. Let me now move to the areas that I gather you were asked to testify on, and I appreciate all your expertise and your time here today and your patience with us. It's really hard to explain to the American people all the things the federal government does. And so sometimes I think it's easier to think in metaphors. So if you'll forgive me for asking a question in areas where you have no expertise, but is vastly simpler. Let's imagine you were running a small business, a simple business that doesn't make things, you just buy stuff that other people make, you hold it in inventory, and you sell it in a commission-based model, a car dealership, right? Suppose, furthermore, that you were a deeply unethical person, and so you maxed out your working capital revolver and said, I'm just going to burn down this business, I'm going to default on my loan, and just strip the cash out of the business. Would you find it easy to predict when you will run out of cash?
I mean, I think it's a tricky comparison because a small business like that's not quite as complex.
Well, I guess, like, and I'm not trying to be cute about this, but you know, you've got extraordinary measures, right? You could sell down your inventory. As you sell down your inventory, you got less stuff on the lot. You've got, you know, some salaries that are fixed, some rent that's fixed, but your commissions are going to depend on what you sell, right? I mean, would it be complicated to try to think through and think, when am I going to run out of cash as I'm being deeply unethical and running this business into the ground?
I mean, I think that from the Treasury standpoint, at least, the expenditure side is a little easier to predict. It's the revenue side that is more uncertain. It's not, you know, quite the same thing as selling things. Money comes in unevenly. The expectations this time in terms of payments due around the April 15th filing deadline were a little lower than people expected, so that causes some of the uncertainty.
In the same way that if you've got some high-margin cars in the lot and some low-margin cars in the lot, and your sales force is sitting there saying, this guy's running the business down, how hard do I want to work here? It might be hard to project those revenues, wouldn't it?
Yeah, generally, I think that's the thing that Treasury is most challenged by, or it's one of the challenges that they face when they try to predict the extent.
Well, And I'm not trying to belabor that point, because I don't want to suggest that the U.S. is a car dealership. We do more important things than that. But it would be legitimately hard to calculate that, because I have a small number of fixed costs, I have a high number of variable costs. I would submit to you that most businesses, the top line is the hardest thing to predict. And yet, even in that case, it's hard. And in that example that I just gave, it is a completely self-inflicted wound that is created by an unethical owner who decided to strip cash out of the business and default on his loans. There is a legitimate problem when your revenues fall under your expenses. There is a completely imaginary problem created by the debt limit. It is possible to turn imaginary problems into real problems by choosing not to pay, by forcing folks like you to go through all this analysis of how do you run the business if you are choosing to do a deeply unethical thing and default on the obligations you already stepped into. My Republican colleagues have proven that they have the capability to turn imaginary problems into real problems. Congratulations. I have too much respect for you all as public servants. I have too much respect for the majority of the people in this country who work for the government, who want to do public service, to say anything to you right now except that I'm sorry you had to come here today. I'm sorry that you had to go through the stresses of last week with Treasury. We should not have done that to you, and I hope that everybody acts like adults next time and focuses on the real problems so that we can now get back to, I don't know, putting on gas stoves. Yield back.
Gentleman's time has expired. The gentleman from Florida, Mr. Donalds, is now recognized.
Thank you, Chairman. Witnesses, thanks for being here. I have no idea what that analogy or symbol or whatever that was, even that doesn't make any sense at all. So I'm clueless on that. A couple of things that have already come up in this hearing about taxes. Listen, the top 20% pay 70% of all federal income taxes in this country. Actually, under the Tax Cut and Jobs Act, middle-income Americans are paying less in federal income taxes. That's the data, that's the facts. My colleagues on the other side of the aisle love saying how the Tax Cut and Jobs Act cost us $2 trillion. Well, that's a lie, because even last year, $900 billion came in over on top of CBO's estimate of tax receipts from Tax Cut and Jobs Act. So I think it's time that we start putting to rest the ridiculous political arguments that typically come from the other side of the aisle. I do want to focus in on the concept of actual national default, because this is actually an important one. We are spending far more money than we have. We're $32 trillion in debt. Most people know the major high point data pieces. But when it comes to the debt ceiling, it is actually nebulous for the American people what default actually means. The press loves saying it. Members on Capitol Hill love saying it. But what are we actually talking about? So, and you guys can tag team this, it's up to you, I don't really care who answers. But I think it's important that we get to brass tacks. If we cross the debt ceiling now in January 1 of 25, if we come to that date and there is no authorization from Congress to raise the debt ceiling, what does that actually mean? Does that mean that our economy cascades? Does that mean that we have no ability to borrow additional money to pay for the other obligations or the other spending priorities that Congress has authorized? Does that mean that interest on the debt is no longer paid?
So I think some of that to determine what it would actually look like still rests with Treasury. But if you're constrained by the debt limit, you can only engage in spending that's contractually obligated to the extent that money is coming in on a day-to-day basis.
Okay, so I want to freeze you on that one, because this is important. So if you're past the debt limit without raising the statutory cap on how much money you can borrow, then Treasury is constrained to only spending money on the things that the federal government is contractually obligated to pay as long as they have dollars to pay it. Is that correct?
That's right. They only have the money that's coming in to make payments.
Okay. Secondarily, does Treasury have the ability to make interest and/or principal payments on existing debt obligations as long as they have the cash to do so?
We think that they do, and we think they were considering that in 2011 based on public records.
Okay. Third question to follow up. If there is a tranche of Treasury bonds underneath the statutory cap, does Treasury have the ability to refinance said bonds in the bond market even though Congress has not elevated the statutory cap.
We believe Treasury can roll over existing debt.
So Treasury can roll over existing debt, they can make payments on existing debt, they can make payments on other contractually obligated operations as long as they have cash to do so. And that are the broad three parameters of what a quote-unquote default is in the United States. Is that correct?
Yeah, I think that's right.
Okay. So this is important. I'm not trying to play politics. I'm trying to understand exactly what we're talking about, because we're going to come to the debt ceiling again. And it's important for the American people to understand exactly what happens and what doesn't happen if Congress does not, for whatever the reasons are, not engage in raising the debt ceiling. So I used to work in finance. If a company that I was financing cut operations because they could no longer fund those operations, but they continue to make the payments on the money that I lent them, is that a default on their debt obligations?
I couldn't answer that. I would only say that we may not be able to make all payments under.
So let me answer it for you. As a former banker, if the company had to cease other operations, but they still paid me my loan payments, that is not a default on the debt that they have extended. Now, I do recognize that if Congress does not have the ability to raise, or the government doesn't have the ability to continue to borrow money to fund all the operations of government, that there are some contracts that would not be paid in that time period of not raising the debt ceiling. Here's my final question to you. How is that different from a shutdown scenario when the federal government doesn't pass budget appropriations?
You want to answer it, or?
The gentleman's time has expired. Can the witness answer for the record, please?
Yeah, we can get that for the.
Okay, thank you.
Oh, for the record.
Sorry, the gentleman's time has expired. All right, the gentleman from Tennessee, Mr. Ogles, is now recognized, and he has the prerogative to ask that same question for his colleague from Florida.
I yield to so you can answer the question. We're on the clock.
I mean, I think they're slightly different in the shutdown means there's been a lapse in appropriations, federal agencies. There are certain things they can do. There are certain things that they can't do because they don't have the authorization without running into the Anti-Deficiency Act. That's a little different from the scenario of what would happen if Treasury didn't have the funds to make the payments, whether it's to bondholders, interest and principal, or to contracts, other obligations that Treasury has. So they're slightly different.
I'd also say with the shutdown, Congress and policymakers in general are controlling exactly what is being funded and what is not. With a debt limit, I think it's uncertain, and that's probably in the hands of Treasury and just subject to the kind of flow of the federal budget.
And I think to close on my colleague's point, the language used and the rhetoric used by Treasury to intimidate American citizens in believing that we are in more dire circumstances than we were is unacceptable. Mr. Chairman, the rhetoric from the other side in this hearing has been unacceptable. According to the Nonpartisan Tax Policy Center, as a result of the Tax Cut and Jobs Act, households in the top 20% of income earnings will pay 87% of the federal income tax collected. That's an increase from 84%. By contrast, those in the lower 60% of income earners will pay 4.3. That, sir, is a decrease. So you're talking about 87% versus 4.3. We know who's paying their fair share and who is not. And so the rhetoric from the other side is unacceptable, Mr. Chairman. It should also be noted that liberal Democrats in blue states have tried to push for the SALT deduction to benefit their rich friends. So we are being responsible when it comes to who's paying what and what for. I also will take issue with the other side in response to earlier comments that that bills weren't germane. The things that we were discussing weren't relevant. And yet 3 of the bills go directly to the problem of lack of information from the federal agencies about federal debt management, especially around adverse contingencies such as the debt limit impasse. 3 other bills relate to effects we've seen from rapidly rising interest rates, which contributed to the bank failures, to the debt limit impasse, and injected uncertainties into debt securities. So I would argue, Mr. Chairman, that what has been brought up in committee by our side are important topics that have to be discussed. Now, Mr. Arkin, you've testified that deficits are fueling unsustainable debt levels, and I'm running tight on time, so I just want to point out that according to the data from the Office of Management and Budget and the St. Louis Fed, the federal revenue reached 19.23% of GDP in 2022. How does that compare to historic levels? Any idea, quickly?
Yeah, that's a bit higher than it's been over the past 50 years, where it's closer to 17.5%.
A bit higher.
Yeah.
Only 3 times in American history have federal tax receipts been higher than in 2022. That was 1944 and 45, at the peak of World War II, and in 2000, during the dot-com boom. So we have peak revenue, and we still ran a $1.4 trillion deficit. Mr. Chairman, we don't have a revenue problem. We have a spending problem. Like the $1.2 trillion in green energy subsidies that were crammed down Americans' throats just a few months ago. So if we're going to get serious about fixing the economy, about curbing inflation, we've got to start talking about spending. We have to become energy independent and stop giving deductions to rich Democrats in blue states. Mr. Chairman, I yield back.
Gentleman yields. Gentleman from South Carolina, Mr. Norman's recognized for 5 minutes.
Thank you, Mr. Chairman. Just want to follow up with this discussion we've had on the X date of when we were actually going to reach the debt limit. I think in reading some of this material, the mantra that y'all operate under is to issue debt in a responsible manner, provide transparency, and to auction the debt in a meaningful way. Regarding transparency, if this were, Ms. Yellen moved the date that the country was running out of money 3 times. It was June 1, then June 5th, then I think it could have been sometime from what we heard, in July. With this important date, why months ahead was there not some indication or some basis of her picking these dates? If you go to a mechanic and he says your car is going to blow up, I think he would owe you an explanation of why. Is it the gauges? Is it the sound? On something this important, why was this not done in the interest of transparency for the American people? And either one, Mr. Driessen or Mr. Arkin, either one.
Yeah, so I can't speak to the transparency question directly. I will say, if you look at last year's kind of ebb and flow of federal budgeting, early to mid-June is right on a kind of a threshold of when we run deficits in early June to surpluses in the remainder of June. And then you get that $143 billion one-time extraordinary measure I mentioned in my opening remarks, which is why there was kind of this, even in the weeks leading up, you've heard testimony from other folks that early June was a possibility, but also July and August was a possibility.
Yeah, when there's something that important, and particularly in light that we had a president who just wouldn't meet. He played it out to the last end, I think, for leverage. It worked pretty well. It was a horrible bill that was the giveaway that we passed in this bill was unbelievable. She's got, she can, why wouldn't she prove her extraordinary measures? She's got the ability to move funds from one agency to the next. Why wasn't that done for transparency? And the American people, I think, are owed that. That never happened.
Yeah, I mean, I can't speak to kind of what was internal discussions at Treasury. They look to minimize borrowing costs and maximize transparency, but Congress can certainly ask for.
We did. We sent letters. We didn't get a response.
And then there are also legal options. So I That's,
Well, especially in light, I think what's extraordinary was you've got, like a state like California, 51 counties, you had delays in when the tax revenue was due. That, we never got an explanation. We said, I think 3 or 4 letters were sent. We never got any type response. That's a dereliction of duty. That's not fair.
I can say there was like the delay in certain states where disasters were hit to, permissible delays in filing is one possible explanation as to why revenues were a bit lower in April than we thought.
Yeah, that's, I would agree with that, but we don't, have a sense of explanations, I guess, for Treasury in terms of the transparency issue or how they communicate that to Congress.
Well, we're going to reach the debt limit again, and hopefully there'll be a Secretary of Treasury who will take transparency seriously, and will let the American people know in no uncertain terms if this is a real date. I never bought those dates to begin with. But be that as it is, it was a constant drumbeat by the media. We're running out of money. Bond payments aren't going to be made. Social Security payments aren't not going to be made. Medical payments, veteran payments are not going to be made. That was a steady drumbeat, which is so unfair to the American people. Should have been done months ahead of time. And I realize this probably is not in your purview, but in your roles, it sure would be helpful to urge press conferences to let people know, regardless of whether you're a Democrat or Republican. I think you're owed that. Mr. Chairman, thank you for holding this, and I yield back.
The gentleman yielded back. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for their response. I'd like to ask our witnesses to please respond as promptly as you are able. And with that, the hearing is adjourned.